Imagine the brightest minds of 1720, from great merchants to Sir Isaac Newton himself, swept up by an investment frenzy. Newton famously quipped, "I can calculate the movement of the stars, but not the madness of men," after losing heavily on South Sea stock. What was this madness that so thoroughly duped Britain's elites? In 1720, the South Sea Company promised gold and glory, a government-backed trading monopoly in the Spanish Americas, in exchange for Britain's huge war debt. Within months, that promise burst like a bubble, ruining tens of thousands of investors and shaking the nation to its core. How did an ostensibly patriotic debt relief scheme turn into a national catastrophe? The answer is a tale of unchecked greed, wild rumors, and a scam so brazen that history still calls it the world's first Ponzi scheme. In fact, early critics warned of its hollowness. One MP estimated the stock was worth only about £200, essentially prophetic truth. We will peel back the layers of this story, section by section. Its origins, the rising mania, the shattering crash, the aftermath and attempted fixes, and then draw modern parallels. Along the way, we'll see a cautionary pattern of human folly and delayed revelations. The narrative plays out like a financial thriller, and in the end, we'll extract 3 clear lessons. But first, we must challenge the assumption that only fools get caught in bubbles. Even the smartest and most powerful can fall prey to collective hysteria, and that's exactly the mystery at the heart of the South Sea bubble.
Britain's burden, debt, war, and the birth of a company.
In the early 1700s, Britain was burdened by a crushing war debt from fighting France in the War of the Spanish Succession, 1701 to 1713. By 1711, the Treasury was desperate. Into this vacuum stepped Robert Harley, 1st Earl of Oxford, a Tory leader and financier who engineered a daring debt-for-trade plan. Parliament chartered the South Sea Company in 1711. On paper, it would consolidate and reduce national debt, and in return, it gained a monopoly on trade with Spanish South America. Under the 1713 Treaty of Utrecht, Britain won the so-called Asiento, the exclusive 30-year contract to ship African slaves to Spanish colonies, and Harley promptly sold this monopoly to the South Sea Company for £7.5 million. In theory, the company could also send one 500-ton navio de permiso to trade duty-free goods every year. The Crown even withdrew its own 25% share of profits, further sweetening the deal. In practice, however, the gold-filled promise never materialized. Spain begrudged British trade, taxed and limited slave shipments, and warfare resumed by 1718, suspending trade completely. Yet public confidence soared. Investors assumed the Spanish crown would soon open the floodgates of silver and spices to English enterprise. The company began by offering a 6% dividend, which sounded safe and generous for the era. Even with no actual profits yet, people queued to buy stock. By 1718, King George I himself took the company's helm as governor, a symbolic endorsement that sent share prices surging. Nothing instills confidence quite like the endorsement of the ruling monarch, notes one historian, and in fact, around 1718 to 19, South Sea shares were briefly yielding 100% interest on paper, entirely based on speculation and rumors. The company was literally buying and selling its own shares to simulate profits, and even bribing insiders to keep demand high. South Sea House Dividend Hall, Etching, 1810. Investors met here to trade stock amid dreams of fabled American riches. In reality, in spite of the company's lack of trade or actual commercial value, speculators continued to invest with expectations of future profit. The stage was set. a country drowning in debt and a company with grand privileges but scant real earnings. Underneath it all, legal tweaks were happening. British bondholders began swapping annuities for shares, trusting that London could magically turn debt into treasure. Sounded clever, but it was built on a fragile foundation of hope rather than hard commerce. A few voices saw through the scheme. William Aislabie, the Chancellor, and pamphleteers like Archibald Hutchison warned that the stock was grossly overvalued. Hutchison pegged its true worth at about £200 per share, a fraction of its coming peak. But in 1719, the alchemy of credit and hype overtook caution. By early 1719, the South Sea Company had convinced Parliament to let it assume more debt. Inspired by the French Mississippi scheme of John Law, the directors proposed to swap out the entire floating national debt, tens of millions of pounds, for company stock. Parliament agreed in April 1720, and money flooded into South Sea shares. The mechanics were perverse. Bondholders and annuitants could convert securities into SS stock, and the higher the stock price climbed, the more the company stood to gain. Insiders even granted themselves options to sell shares back at future market prices. It was a self-reinforcing frenzy. The result was astonishing. In January 1720, the stock traded around £128 per share. By July, thanks to wave after wave of new speculators, it was roughly £950, nearly an eightfold jump. One study of historical bubbles notes the same surge, from £125 to £950 in just 7 months. By August, the price briefly reached £1,000. During these months, ordinary citizens and gentry alike poured in life savings on promises of untold riches from slave-run gold mines and Caribbean trade routes that, in truth, barely existed. Even savvy professionals blanched at the profits whirring off the conveyor belt of hype. To feed the mania, the company and its allies spread tall tales. Public announcements spoke of a fund of credit worth £70 million backing expansion. Glamour newspapers reported that South Sea directors were befriending prime ministers and aristocrats by distributing free shares, literally handing out opportunities that magically grew overnight. One pamphlet called it the first financial Ponzi scheme, as the only profit was made by those at the top of the loop. Hundreds of other joint stock ventures sprang up in London to cash in on the craze. Everything from hair trading companies to perpetual motion corporations. The frenzy was unchecked. Share price of the South Sea Company, January to July 1720. A meteoric climb and, beyond the right end of this chart, the impending crash. By mid-1720, one could say the entire economy was humming on speculation. The Bank of England had even offered a competing debt conversion plan, but it was outbid by South Sea schemers. Parliament quickly brushed aside rivals and codified the company's power. Both major parties, Whig and Tory, fell under its spell. Even King George's mistress and a dozen cabinet ministers quietly accepted share options. They stood to make hundreds for every pound the stock rose. With insiders on board, public trust, or at least inertia, carried it higher. As one contemporary wrote, England was caught up in a speculating frenzy, which, in hindsight, should have been taken as a dire warning sign.
Act 2. The Delusion. Peaks and the crack appears. Late summer 1720.
With the stock soaring, everything seemed rosy, until it wasn't. By late summer 1720, the system's flaw became obvious. There were no real profits to sustain these wild prices. The company had used share sales, not trade revenues, to cover its debts and dividends. Each new share issue diluted the wealth of older investors. Meanwhile, John Blunt and other insiders quietly began to sell. In August 1720, sensing the market was overstretched, Blunt liquidated his entire holding. Within days, others followed. One historian notes, "Soon everyone was a seller, and no one was buying." On September 17, 20, the air went out of the bubble. Rumors of investigations and fears that all value was illusions triggered a panic. The price swung from £1,000 downwards. By October, it had fallen precipitously, and by December, a share of South Sea stock traded at just £124, an 80% crash from the summer peak. Some accounts say as low as £135 by late September. Other speculative ventures were destroyed even more completely. Holders of made-up enterprises like the Perpetual Motion Company woke to find their paper was worthless. The collapse was brutal. Investors of all classes were crushed. Aristocrats who had mortgaged estates, merchants who spent fortunes, and paupers who gambled savings on one last chance. The sudden losses triggered bankruptcies and financial panic across Britain. Banks exposed to the crash failed. Trade was disrupted by lack of funds. Even suicides spiked as desperate people lost everything. In a matter of weeks, the same street scenes that had been full of celebration turned angry and fearful. Crowds gathered in London, demanding accountability. On one side, Newton and countless others were bewildered by the irrationality. On the other, alarmed lawmakers and journalists raced to untangle the truth. The House of Commons convened a special inquiry. When the dust finally settled, it revealed staggering corruption. Company directors had been bribing officials, selling fraudulent stock options, and bilking new investors to pay off old ones. Historians call it a parliamentary and financial scandal of epic proportions.
Act 3. Justice, Reform, and the Rise of Walpole.
As fury mounted, Robert Walpole, a previously sidelined Whig who had long warned of the scheme's dangers, came to the rescue. In late 1720, Walpole was appointed Chancellor of the Exchequer and effectively assumed control of the crisis response. Under immense public pressure, Parliament impeached the company's leadership. All 33 directors were ousted, and on average, 82% of each director's wealth was confiscated to compensate creditors and victims. The surviving stock of the company was handed over to the Bank of England and the East India Company, strengthening those institutions. Walpole even persuaded the Commons to spare the king's favorites. He reportedly won votes by the slimmest of margins to protect George I and his mistress from being charged. In the aftermath, sweeping laws were enacted. In June 1720, ironically before the crash fully hit, Parliament had already passed the Bubble Act, forbidding the formation of new joint stock companies without a royal charter. This measure, driven by panic over rampant scams, essentially stalled new public share companies for decades. After the crisis, any lingering South Sea Company business was wound down. By 1750, it had lost its special privileges, and by 1807 was stripped of all exclusivity. Technically, it lingered in paper form until 1853, but its grand trading days were over. Public confidence needed rebuilding. Walpole's steady hand in stabilizing credit made him a national hero. He delivered a pamphlet to Parliament noting that while enormous fortunes were lost, those who had gambled and bet correctly or been tipped off by insiders actually made a fortune. Indeed, not everyone was ruined. The treasurer, Thomas Guy, sold early and used his gains to found Guy's Hospital. Many bankers and politicians had quietly profited. Some had even taken bribes from the company. But for the average citizen, it was a lesson in caution, one that, unfortunately, the next generation seemed to forget. The Bulbous Bubble Act and Walpole's reforms did help prevent immediate copycats. Only 2 bubble companies gained royal charters and survive to this day: the insurance firms Royal Exchange and London Assurance. Otherwise, the nation was left bruised but more aware of unchecked speculation. Newspapers and cartoons, most famously William Hogarth's South Sea Scheme engraving, memorialized the folly as a moral warning. Even Thomas More later penned verses comparing stock bubbles to fragile soap bubbles.
Act 4. The modern echoes of 1720.
The South Sea bubble left an enduring template: boom, hype, collapse. Shockingly, financial history repeats these patterns. For example, the late 1990s dot-com bubble saw something eerily similar. The Nasdaq stock index soared 600% between 1995 and its peak in March 2000, only to crash 78% by 2002, wiping out the entire gain. Likewise, the US housing market in the mid-2000s doubled in price and fueled a boom, then fell by about 20% from its peak 2006 into 2009, sparking a global recession. Recently, even cryptocurrency mania has mirrored 1720's frenzy. In 2021, the price of Dogecoin, a meme crypto, surged 20,000% in just 1 year, then plummeted 93% as the euphoria faded. Bitcoin raced to record highs above $64,000 and then fell dramatically. By late 2022, major news outlets were blunt. The crypto bubble had definitively popped, taking with it billions of dollars of investments made by regular people, pension funds, venture capitalists, and traditional companies. Regulators even warned skeptically. The UK's Financial Conduct Authority told investors in January 2021 to be prepared to lose all their money in crypto assets. The parallels are clear. Each cycle involves impossible promises of wealth and the same emotional drivers. As one modern commentator notes, today's cryptocurrency hype feels uncannily like 1720, promoters making what a historian called impossible promises about riches in the new world. Recently, even cryptocurrency mania has mirrored 1720's frenzy. In 2021, the price of Dogecoin, a meme crypto, surged 20,000% in just 1 year, then plummeted 93% as the euphoria faded. Bitcoin raced to record highs above $64,000 and then fell dramatically. By late 2022, major news outlets were blunt. The crypto bubble had definitively popped, taking with it billions of dollars of investments made by regular people, pension funds, venture capitalists, and traditional companies. Regulators even warned skeptically. The UK's Financial Conduct Authority told investors in January 2021 to be prepared to lose all their money in crypto assets. The parallels are clear. Each cycle involves impossible promises of wealth and the same emotional drivers. As one modern commentator notes, today's cryptocurrency hype feels uncannily like 1720, promoters making what a historian called impossible promises about riches in the new world. The lesson is that human nature, fear, greed, FOMO, fear of missing out, doesn't change. Whatever the century, people can be swept up in herd mania. The specifics differ: tulip bulbs, railroad shares, dot-coms, crypto tokens, but the cause and effect story is the same. The South Sea bubble was not an isolated fluke, but the earliest chapter of a recurring financial saga. By studying it closely, we start to recognize the warning signs: sky-high valuations, celebrity endorsements, exotic new ventures, debt-fueled investment, and general euphoria. In 1720, the scheme was government-backed and presented as debt relief for the nation. Today, it might appear as cutting-edge tech or alternative assets, but in spirit, the playbook is unchanged. Beware too good to be true promises. Every grand scheme that guarantees huge profits with no clear source should ring alarm bells. The South Sea Company was hailed as Britain's salvation, yet it ended in ruin. Analysts today often cite 1720 as the archetypal Ponzi scheme. The only profit was made by earlier investors at the expense of later ones. Always question whether a business is truly generating value or just spinning its own stock. Even the brightest can be fooled. Newton, Nobel-worthy economists, and powerful politicians all got swept up in the 1720s hysteria. Don't assume intelligence alone protects you from groupthink. Study fundamentals and be wary of crowd psychology. When everyone around you is euphoric, remember Hutcheson's voice in 1720. The actual value is 200 pounds. History rhymes. Study it to avoid mistakes. Bubbles follow predictable paths. The South Sea bubble taught regulators and investors a hard lesson, but humanity keeps forgetting it. Modern episodes, from dot-coms to cryptos, share the same DNA. As historians note, cryptocurrency mania has been compared directly to South Sea mania. Understanding past scams helps us spot future ones. In practical terms, that means diversifying investments, doing rigorous due diligence, and being ready to step back if rationality gives way to mania. Above all, remember that financial markets are ultimately driven by people. They can be logical, but they can also be wildly irrational. The South Sea bubble is a dramatic warning that bubbles can form when unchecked enthusiasm overrides reason. The more we learn about this 1720 disaster, the better we can guard against the next one. Only time will tell where the next bubble lies hidden, but history suggests it's probably hatching right now in some corner of the globe. Thank you for joining this deep dive into the South Sea bubble. If you found this story compelling, like this video and subscribe for more history and finance investigations. Leave a comment below on what modern bubbles you think history might be repeating. Stay curious and stay cautious.